Just gonna hang out 1 second, just let a few more people join. Okay, let's get started. So good morning. Thank you for joining us today. We want today's presentation to be lively and interactive. So please send any questions you may have to info@KraneShares.com. And if you are streaming on the KFA Fund, send it to info@KraneShares.com if you are streaming on the KFA Fund's website. If you are joining via Zoom, send your questions directly through the Q&A button at the bottom of the screen. We are offering one CIMA CFP credit for attending today's presentation. If you want credit, please email ce@KraneShares.com. So good morning. Thank you for joining us for this webinar where we talk about the Fed cuts and how managed futures, or the recent Fed cuts and how managed futures navigated the choppy seas of pandemicflation, which is a bit of a mouthful of a word. Before we get started today, I wanted to go, take a few moments to talk about why managed futures and review why managed futures is a important part of the investor portfolio, the type of investor premium that we're trying to earn, and how that investor premium relates to the total portfolio and how it diversifies a traditional portfolio. So when we think about managed futures and investing in the futures markets, we have to think about where the investment premium comes from for investors like us. Traditional markets are well understood. The investor risk premium is well understood in traditional markets and equity markets, bond and credit markets. Basically, businesses and companies are using those markets to raise capital to build and grow their businesses. And in return, investors seek to earn a risk premium over time through capital appreciation, share in earnings, dividends, etc. So that is a well understood marketplace. That investment premium exists on the long side primarily. All the indexes that look to measure traditional markets are long only buy and hold type of indexes. When we think about the futures markets and why they exist, they've existed for a long period of time, over 150 years, in the form of exchanges, and going back before, back in I think it goes all the way back in the times of Hammurabi's code in BC. To where people were using forwards to lock in futures prices. But the managed futures space has existed, since the 1980s, for sure. Futures investing is, clearly been going on in exchanges for a while. The reason they exist primarily, and I think this is the most important thing to understand about futures markets, is they exist so that businesses and companies can hedge exogenous price risk that they face and transfer that price risk to investors like us that are willing to accept that price risk. So you have corn farmers that need to sell corn. If the price of corn goes down, they're at risk of their business is at risk if the prices of corn goes down between the time they plant it and when they harvest it. They go into the futures market. And they're willing to sell that risk away to people that are willing to accept that price risk. If the price of corn does go down over the next 6 months after they plant it, fine, no big deal. They're able to run their businesses more efficiently and move forward. So that ultimately, in the managed future space, in the trend following space, what we are trying to accomplish and what we are doing, the premium we're trying to earn, is systematically owning price risk and taking price risk in the FX, in the bonds, and in the commodity markets, own that price risk in a systematic way. And the way we do that is through trend following. Over and over again, we're looking at prices every single day. If the prices are going up, we will get long and we'll own that futures contract as long as those prices are going up. And in periods like inflation and deflation, when there's big price dislocations and big risk moves in particular markets, we earn our investor premium there. When we have stable markets and markets aren't moving around, or choppy markets, we have price stability that we're not earning a risk premium there. So in general, that is why we own managed futures. We tend to get because of the way we access those markets through trend following, it tends to kick off a positively skewed return distribution. So we tend to own, so that's what we're looking for. We're looking for those big price dislocations where we make a lot of money from, or a large profit from a market moving up or a market moving down in a big way. So our tails tend to be on the positive side, on the right tails. But what that also means in a positively skewed distribution, so we get the positive tails, but the bulk of our returns end up being below the mean. That is very different than from traditional markets that have a negatively tailed distribution. Their big risks are on the left-hand tail, but the bulk of their returns are above the mean. So it feels really good to own equities every single day. You get a lot of positive reinforcement for owning equities. On the managed futures side, it's a tougher hold, but the payoff that you get in those right tails tend to happen at the same time as you're getting those negative tail events in equities, and that's what makes pairing managed futures with traditional investments such a powerful mechanism. So it's important to understand why we hold this in the portfolio, the challenges of holding managed futures in a portfolio, and knowing that over time the risk profile, the investor risk premium you're earning in managed futures is going to be diversifying to your other investments. It is a liquid asset class. It's probably I would say from an alternatives world, the most powerful diversification that you can add to traditional investments, because it is liquid, because when you're getting returns, those diversifying returns, you're able to monetize that diversification and pour it back into the rest of your asset allocation, so that you get that. Diversification doesn't do a lot of good if you don't have, if you're not able to rebalance and pour that diversification back into the rest of your portfolio. So that's a little bit of the background on why we're doing this in the first place. If we move the slide one forward, guys. Mount Lucas has been in the managed futures business for almost 40 years now. Started in 1986. In 1988, we created the MLM index, which was a passive way to trend follow markets in the managed futures space, to provide a beta index for earning the investor risk premium in managed futures, or for participating in the futures market. We trade 3 asset classes: global fixed income, currency, and commodity markets. Most of the exposure goes to global fixed income markets because they are the least volatile asset class. Then currencies, then commodities have the lowest allocation because they are the most volatile asset class. The goal here is to have an equal risk contribution over time from these 3 asset classes, and we believe that in the fullness of time, that's about what we get. I think the other thing that is important on the managed futures side is the ability to go long and short these asset classes, and that sort of dynamic mechanism allows you to participate both on the long and the short side of different types of moves. And that's what we're going to go through today, is how managed futures has reacted to different market environments, how being short bonds in an inflationary period can be positive, how being short commodities in a deflationary period can be positive, or long commodities in an inflationary period can be positive. So being long the dollar during certain periods, being short the dollar during certain periods. Go ahead one slide, guys. And again, you see that in this chart here. This is sort of the exposures since the turn of the century. And you can see, right there during the pandemic, getting really short commodity exposure, but then turning around and being long commodity exposures into 22, and then being sort of neutral and bounced around sort of since 2023. Again, you see the exposures relative to the dollar, some positive exposures on the currency side. We're long the foreign currency and short the dollar. So, we're long early in that graph in 2020, we're long the dollar, then we get short the dollar, then long the dollar again. And you see how we've moved, that dollar exposure has moved through time. And again, on the fixed income markets, which we'll talk a bunch more going forward. So with that, I'm going to hand it off to our Co-Chief Investment Officer, David Aspell, who's going to, sort of review the lay of the land since the turn of the decade here. So.
Okay, hi. Thanks, everyone. Thanks, Gerald. Can we zip on forward to the next slide? There's a couple of questions popped in, so I'll just run through the first one on managed futures and trend following. We've been asked about the time frames that we represent. Generally speaking, what that means is for others is that trends are something that you can define over fairly short windows, maybe a look back period of a couple of weeks and months. Maybe it's a medium term trend where you're looking at 3 months or a quarter, or longer term trends. Generally, we're at the longer end of that trend following exposure. Over time, we think that's provided the best diversification and also has provided the best returns, that you end up getting more of the bulk of the moves. So generally, we're at the longer end. Okay, so we thought now would be a good time to review things, partly because this decade has been quite wild. We've seen rates crash to zero through a pandemic that shook the world and hit equity markets really hard. Then we saw the pandemic, largely through vaccines, kind of help the world move through, and an economic rebound as vaccines came through. And then we've seen a resurgent inflation to levels that we've not seen in some 40, 50 years, which after seeing rates go to zero, we then saw rates hit 5% in the US. After lots of stimulus, we've seen wars in Europe. So it's been a wild ride for this first few years. So we thought that now that largely the big story for the past few years has been around inflation and the Fed rate hikes in markets, we thought now would be a good time to review, given that it looks like inflation is almost maybe back to the point where we need to be. The chart we've got here shows headline CPI. You can see the spike to 9%, and now we're back at a level which this uses the Fed targets at inflation using PCE around 2%, and normally headline CPI usually runs a little above that, so that's why the band is a little higher. But if you were the Fed, you're almost looking at a tentative mission accomplished, and this might be the soft landing that you've got. As everyone knows, we've cut rates now, so we thought this would be a great time to review what we've seen. So if we can move on to the next slide. So the first part of the decade was characterized by the pandemic. A wild time in markets, something not seen markets move like that for a very long period of time. So we thought we would review here how trend following and our version of trend following was able to diversify equities. You can see in this chart, we use a version of this chart going through the presentation. So I'll just briefly run through what we've got. We've got the KFA MLM index in the dark blue line. We've got the S&P 500 in the light blue line. And you can see generally they're going in opposite directions at the start of the pandemic, as equity markets get hit quite hard and fall some 30-odd% in very short order. And you can see here the positions are denoted by the colors, by asset classes behind, where red positions, or more red and orange, are short positions, and the green positions are markets where we're long. So they're broken out by asset class, commodities at the top, And then we've got the short version of the ticker symbol there. So the very top line labeled HG is for copper, and then a couple below that we've got CL, which is crude oil. So you can see what that means is that for that period of time in this chart, we're showing all of 2020. The red line for crude oil shows that we're fully short. So the interesting thing is, we've seen some wild moves. We've seen rates collapse, and we've seen wars and fiscal stimulus. We've seen oil start the decade at around $60, and then it traded negative, believe it or not. We'll come on to that later on in, I think, May 2022, and then traded $130 after that. So it's been a wild ride, but we can run through.
Hey, Dave, real quick, there's a question here, and I think this chart shows it pretty well about, you talk about using KMLM as portfolio insurance. How can I tell when to rebalance KMLM when it spikes? You want to speak to that, or do you want me to jump in?
Yeah, it's a difficult question. I mean, generally what we're trying to do is get that tail type of exposure so that when equities are really, really hurting, you can take the gains that you're making in managed futures, sell some of that down, and then rebalance into stocks. There's no real right way to do it. Generally, we think that doing it daily or weekly is overkill. But then you don't want to leave it run into years either. Generally, how we use it inside portfolios we run is that we do it on a regular cadence, just so you get into the habit of doing it. We do it monthly. Other people like to use a thresholding approach, where if you're targeting, say, an 80-20 or a 70-30 allocation, and they get particularly unbalanced because stocks have fallen, managed futures have moved up a lot, and suddenly maybe in that world you're targeting 70-30, but at that point you're at 60-40, and you've moved outside a comfortable threshold. You can do it then and rebalance then, but there's really no perfect right answer. I think the right answer for us is to do it whenever you feel comfortable and just get into a habit of doing it and treat it as a portfolio element that you have on all the time, and just keep on rebalancing whenever you're comfortable. But yeah, it's a hard question to know when these trends are going to actually start to when the peak is an impossible question. So I think just doing it on a regular basis is the right way to go. That's a good question though. Yeah, it's a hard question. So yeah, if we look at the pandemic period, right at the start, you can see the stock market falls very abruptly, falls some 35% through the first quarter. And managed futures does well and makes 20-ish% over that period. And what positions did it? We'll run through a couple in more detail, but in general, being short of commodities was very powerful. You can see that with generally most of the first half of that year is characterized by the red colors, apart from gold, which was along the whole way. Again, it's often a flight to quality asset. And then the other one at the bottom in fixed income, you can see fixed income markets, we were generally long the whole time. So that dynamic asset allocation of being able to be short some things and long others is real powerful. So I think what we're going to do is to zip through to the next slide, where we can run through a couple of individual positions here. The first one is looking at the US bond market. So we're going to use this version of chart a couple of times as well. So I'm going to run through what they are. So in the KFA MLM index, when we're getting US fixed income exposure, we get that through futures contracts. We trade the ultra 10-year bond contract, and the blue line here is a rolled synthetic continuous price series of bond futures. So this is the experience you get if you continually roll forward long positions in bond contracts. And then we have a long-term moving average. So speaking to the question before as to whether we're short, medium, or long-term, we have a moving average here. It's a long-term moving average. And then in green in the bottom, you've got our position moving from 100% short to 100% long. So any green, any positive position on the signal is us being long. So in the run-up to the pandemic, we've got that marked to January 2020. But if you remember what was going on there, the economy was doing fairly well through 2018, then late 2019, the Trump administration trade dispute with China was heating up, and the Fed began cutting rates late in the second half of 2019. So we were already long of bonds at that period going into the pandemic, which was very helpful. And you can see we maintained that long position throughout 2020 and through the February-March period when equity markets are really getting hurt, bond prices moved up by something like 10 to 12% in quite short order as the Fed began the emergency rate cuts, as well as an alphabet soup of other policies and alongside fiscal policy to try and cushion the economy through that period of time. So that spike up in bond yields is one of the places where we were able to make money.
Yeah, and just to hop in real quick, you see the you see the effect here of using a longer term moving average, that we're able to maintain that long position over a significant period of time despite several pullbacks in the bond prices, and I think you're going to see that in a few more of these charts. If you had a shorter term moving average, you'd be running that red line much closer to the blue line, and you would be getting stopped out of that long position, sort of several times throughout the lifespan of this trade. So the trade-off between longer term lookbacks and shorter term lookbacks is basically longer term lookbacks. You get in later, get out later, but don't get chopped up along the way as much. Where shorter term systems get in earlier, get out earlier, but get chopped up along the way. Over the fullness of time, getting that extra getting chopped up or getting stopped out of positions over and over again is too expensive a price to pay. To get in earlier, to get out earlier, and it's too big a drag on performance over time. So most trend followers, most people in the managed future space, the longer term look back periods have stood the test of time better. We've always looked at a 1 year moving average. When we created the index in 1988, we were using a 1 year moving average, and today we're still using a 1 year moving average. So that's part of the MLM index, is that the stability, because it's an index, the stability of parameters, the fact that it hasn't changed, that it continues to explain the returns in this market over long periods of time, without fitting or without moving parameters around, I think is a really powerful piece of the index.
Yeah, for sure. Okay, so if we move to the next slide, we've got another example position, crude oil, which is a fascinating market itself. I'm not sure if people remember, but this actually traded, at least very short dated futures contracts, actually traded negative in I think May of 2020, which is kind of a crazy thing to happen. I don't think it ever happened before. We can run through here the positioning. We've got it again running into the pandemic. We were long of crude oil right at the start of the year, and then as the pandemic begins to take hold, we move to a short position, and through January, February. By the time we get to March, we're fully short. And it's one of the interesting things. One of the benefits of trading commodities is that commodities really do move around a lot. But crude oil going from $60 down to basically zero or under $10 for the later futures contracts it's a really big move. And it's having something that can move that much is really beneficial in helping diversify equity portfolios when they're falling so much. And there's really not that many places where you can get short exposure to anything at all, and certainly not short exposures that are managed and systematic and balanced. So this is an example where being able to have the short side of the return distribution open to you is real valuable as crude oil prices collapsed. Okay, so I think the next part to look at is for commodity markets. If we move to the next slide as well, basically what happened, to some trend followers, these are just a time series where they're just looking at, what is going on. But to us, it's really important to look at the fundamental forces that are underlying what's happening to these markets. So we've got a chart here that just shows total world oil demand and supply on the top, and then a supply and demand deficit chart, which is just the difference between those. And so what is it that caused crude oil to go down so much? So if you think in general, coming into the pandemic and actually around about now, the world uses and produces about 100 million barrels of oil a day. And deviations from that the market is generally pretty much in balance, and deviations from that are the thing that causes large price moves. So if you have a pandemic and everyone stops traveling and stops driving to work, oil demand collapsed, and oil supply reacted, but it takes a while to do that, partly because you can't really just turn on and off oil supply as much as you think. So at the bottom, if you can see, we moved into a period where you had where supply just overwhelmed demand, and in that world, what you normally do is you try and store crude oil, and once that storage becomes full, you've really got to do something different, and it's that oversupply that really caused the market to crash. It's kind of a cool chart that just shows what was actually going on at that time, and that these are the kind of moves that we pick up. Okay, so I think the next one we're going to move on to is after the heat of 2020 and the actual pandemic, we then moved on to a different period where we had vaccines. The fiscal stimulus that we got to help the economy come out of the pandemic was massive. So this period we're looking at is covers the fiscal stimulus, vaccines, the war in Europe, and what that did to markets, and then the subsequent inflation. So I think Jerry's going to run through that section.
Yeah, thanks, Dave. So again, looking at the same chart that we're looking at during the pandemic. This is for the period of 2022. Another difficult period for equity markets. We got a really sustained bear market in equities, and this was for the first time in most investors' investment memory that the Fed put wasn't available, so that every time you got a down move in stocks, you didn't get a rate cut. You didn't get a promise of a rate cut, or a dovish Fed. So we had a period here where bond prices were falling, rates were rising, and equity markets were continuing to drift lower for a long period of time. So I think this was a type of environment that we hadn't seen in a long time. It was a quadrant that most 60-40 portfolios were unprepared for. In reality, there wasn't a lot of assets out there that did well during this period besides managed futures. Managed futures for us at Mount Lucas, having been in this business since the 80s, our founders having been through it in the 70s, remember the last major periods of inflation. They understood that managed futures did well when prices get moving in both directions. And that managed futures would work in a period of inflation. Coming into 22, most people thought about managed futures as a sort of a crisis risk protection or crisis risk alpha, that in deflationary events like after the tech bubble or after the GFC or during the pandemic, that's when you wanted to have managed futures in those sort of pandemic global sell-off demand destruction type of environments. All of a sudden, we got an inflationary environment driven by sort of monetary and fiscal stimulus, compounded with a war starting in Ukraine, between Ukraine and Russia. And we were in an environment that most people hadn't seen in a long time. So from a position standpoint, again, we have the commodities at top. We entered 22 pretty long commodities. It's particularly important is energy and grains. You had the wheat market and natural gas markets that got really tight during that early part of the war. Wheat in particular was 30% of the world's wheat came out of the Ukraine-Russia region, and clearly prices reacted dramatically to that event. I would say most of the run-up in managed futures in the first 5 months, probably through May, were driven on the energy side or on the commodity side. So energies and grains in particular. One interesting thing to note, if you look at the position of gold kind of going across, it was long the first part of the year, then short the second part of the year. But really was no help in this sort of inflationary period. I think it finished about flat on the year. On a price basis. So you know, a lot of people have gold or significant allocations to gold in the portfolio, which again, as David said, is sort of a flight to quality type of a trade. But as you know, when a lot of people own it for inflationary reasons, it didn't do a good job in 2022. But early part of this year, commodities really drove the boat. If you look at the positioning in the bottom half, short foreign currency, so we're long the dollar almost the entire year, and short bonds almost the entire year. Second quarter, third quarter really got rates really started to get going. Dollar got really strong, and through the end of September, that drove performance in managed futures. Before bonds got a bid, or bond prices got a bid there, and backed up a bit on us in the fourth quarter, so we gave back some of those gains. But all in all, a really good performance out of the asset class. In our index did well. The asset class in general did well, sort of across the space. So that sort of goes to the robustness of our approach and a robustness of the managed future space in general. So it really did its job in this period, and was a really good diversifier in a period of time, in a type of environment that we hadn't seen in 40 years. So if we go to the next slide, we'll dig into that a bit at a couple markets. First one's the euro. Again, this chart's less about the euro, more about the dollar. But entering 22, we'd started to build that short position in the euro along the dollar. That trade performed beautifully. Again, the long-term moving average keeps us. Well, it does two things here, right? So it keeps us in that trade for the entire period, and it allows that down move to get extended. And in the deepest part of the stress, we are fully positioned. We have another question here from Justin about why don't we use other methods to determine position side, like distance to the moving average, and what are the trade-offs of using other types of position side? Like, in this chart, why would we let the euro run as opposed to probably taking profits along the way? The reason being is because managed futures and trend following is positively skewed, it is really important to fully own the right tail in these markets, and to really own them, and not be cutting them back in periods of stress and when they really get dislocated. This is when managed futures provides the most amount of diversification to traditional portfolios. It typically happens when stocks are getting hit pretty hard. The last thing you want from your diversifying manager is for them to be de-risking during that period. What you want from us is to be giving you all the diversification that we can. If you're rebalancing again, as we talked about, on a regular cadence, or using a band approach to rebalancing, that allows you as the investor to monetize that diversification and pour it back into your portfolio. If we're the ones cutting back our position sizes, that's us, the manager, monetizing that diversification benefit and making locking up profits, reducing drawdowns, making our Sharpe ratio look better, instead of fully owning that skew, that right tail, and allowing you to monetize that benefit as an investor. So you could see at the end of this chart on the right-hand side, when the euro rallied at the end, we're looking at a long-term moving average. Yeah, that hurts a little bit at the end as we get a trend reversal there. And if we didn't take profits there, but if you were rebalancing at the end of the quarter or at the end of September, that would have gone to you as the investor. We'll go to the next slide. And we talked about wheat a little bit. Everybody sort of knows this story by now. Russia, Ukraine, 30% of the world's wheat production at risk or gone in a really short amount of time. We entered the period, we'd been trending up a bit in wheat and had it established a fully long position going into 22. Things really got going there in March and spiked there, pulled back a bunch, which hurt at the time. Made a second spike, and in that period of time gave the investor a lot of diversification and access to a type of return that they otherwise didn't have. Now it's problem we say in the commodity markets all the time, the cure for high prices is high prices, and the world figures out how to, wheat's a weed, they can grow it anywhere. They figured out how to get the supply out of there. They figured out demand was destructed to a degree, in that now the price of wheat's trading back at prices lower than before the war, which is really amazing because the war is not over. The risk of that supply is not over, but the world's figured out how to adapt. Next slide. Natural gas, similar story as wheat. Natural gas is it's a volatile contract, so you really see the big moves here. Again, neutral, got long pretty quick going into 22. Had a couple wild moves in the middle there, with long-term moving average kind of closed its eyes and hung on for dear life. But all in all, it got access to that long move in natural gas. And similar to wheat, natural gas is back trading at prices at this point today, lower than before the war. So that's sort of some wild moves during this period, and how the index traded them and accessed those returns.
And if you think about this one in particular, right, Jerry? I mean, one of the good things, if you think in early 2022, one of the things that was really hurting equity markets was that there was a war in Europe, and the energy prices were rocketing, and that was going to crimp economic growth in Europe and in the rest of the world. And that, when you think that was what was hurting equity markets, what managed futures are doing here is giving you just direct exposure to the factors that are hurting equity markets. So if you think some portion of the equity drawdown was because of natural gas prices doubling. So if you want to diversify and have something that is a complement to equity markets, there's not that many places where you can get direct exposure to the factors that are really hurting equity markets. And it's this that when you put it in a portfolio with stocks, that's the why of why this works and why we think it's real valuable. And I think if we move on to the next section, this is sort of generally covers the war period. And so after, or at least as the war was sort of moving on, inflation began to spike, and then eventually the Fed began to raise interest rates, and bond yields were starting to rise through that period. So on the next slide, we can look at bonds again. So again, the first time we looked at bonds earlier on was when there was a flight to quality bidders during the pandemic period, when equity markets were crashing and the Fed was slashing rates, and bond markets really rallied. Long only bonds picked up that move, but if you think, once you got to a point where I think the US 10-year yield hit at one point traded underneath 50 basis points, and once you get to that level of low yields, it's really hard for being long bonds to really make much money and to diversify there. And at that point, they were, at least in our views, returnless risk. And we started to see that through 2022 again, when yields really started to rise. You had the area that people thought would help their portfolio started to hurt their portfolio. And this was the other period, the other thing that was really hurting equity market multiples was rates going up. So you can see after the long position for the pandemic, this chart takes over in January 2021. We're still holding on to that long. And then you can see throughout 2021, we're short for a period, and then yields move around. It's a little bit messy. That's the nature of trend following. At the start of 2022, yields really start to move. higher. And then for that whole period, bonds then fell some 20%. Again, this is using the ultra 10-year note contract. So we were short and held a short from February of 22, actually all the way through the summer of this year. Even though it's a little bit of a messy trade, think about what's going on here. Where else could an investor get access to being short fixed income? But there's really not that many places. Most investors are when they're investing, they're going long. They're picking up long positions in stocks and bonds and credits. Sometimes it's the right thing to do is to have exposure to rising interest rates, because that can hurt equity markets. Where else can you get exposure to rising interest rates? Being able to short bonds in a systematic, measured way is really useful. To the question we had earlier on the signal strength side, on the determining position side, one reason we don't do that is we like to know what our position is. So once we're short, you can see our position stays at 100% short. And that means that given that we went through the allocations that we have and that they are broadly fixed, once we're short, we know how short of bonds we're going to be. So if you're using that in a portfolio that has bonds in it as well, you know how short we're going to be, how much of us to use, that when we are fully short bonds, how much of a bond long position in another part of your portfolio is being offset. Whereas if you're moving it around with signal strength, or if you're volatility targeting the positions, you don't know how much exposure your managed futures strategy is going to have to a market. So this chronicles the position from rates going from 0 and yields in the 10-year being around 50 basis points all the way up to when they hit 5% for a hot minute. The other area that we take positions in that we haven't spoken about yet is on the next slide, we're going to run through some currency markets. So the next slide has the dollar yen. And one of the things that drives currencies is the relative interest rates between countries. Not the only thing, but it's often one of the larger factors. So here you can see in blue, we have the 2-year interest rate differential between the US and Japan. So what this is doing is looking at what the 2-year yield is in the US and the 2-year yield is in Japan, subtracting them for each other to get a spread, and then overlaying that spread chart with dollar yen currency. And you can see that they generally move in line. So if you think what was going on at this period, well, Japan generally has been marches to the sound of its own drum with monetary policy. It's had rates, at least it did have rates at 0 for a real long period. It's had very low inflation for decades. And through this period, the Bank of Japan was maintaining a peg level at the 10-year point in the curve, whilst other countries were raising rates by 75 basis points at individual meetings, which puts an enormous interest rate differential between those. And why does that start to move currencies around? Well, if an investor can earn a much higher rate of return in one currency, it leads people to put on carry trades where they can pick up that interest rate differential. So you can see dollar yen moving a lot as interest rates are moving. And on the next slide, you can see how our positioning managed to pick that up. That from this is from the start of start of 2021, the early pit part when interest rates and when yields started to move in the US, we moved into a short position in dollar yen and held that position, for coming on 3 years. There was a small period in the middle where the position was reduced a little, only for it to go back on again right away as the blue line gets close to the red and gets close to the moving average. But broadly, this is an example when Jerry said earlier that we have some of the positions, or generally positions, are below the mean on individual trades, where we often lose small amounts of money sequentially, which is different than stocks and credits. When you really make money in trend following is when you get big outlier moves and currencies moving, by 50% over the course of a couple of years, and just holding on to it. And you get these real outlier moves that can benefit portfolios. And if you think back again, what's going on? What was it that was really hurting equity markets at this time? It was rates going up a lot. How do you get direct exposure to rates going up a lot? The reason we have the rates differential chart is dollar yen is one of the places where you can get direct exposure to the thing that's hurting equity markets. So the thing that's hurting equity markets, interest rates going up a lot. Managed futures can give you direct exposure to that factor, which is how it can make money. That's the how and why that it can help diversify portfolios. So the other area we looked at was corn prices. On the next slide, we looked at corn and soybean prices and wheat coming out of the war. You know what happened over the next couple of years? Well, Jerry said that the best cure for high prices is high prices, and that's really true. What does it encourage people to do? Is when grain prices are real high, well, they buy fertilizer, they grow more of it, and you end up getting very high yields. So what caused grains to sell off? Well, this chart just shows annual corn and soybean yields for the past 40 years or so. We had record yields. Corn yield was around 180, soybean yields just over 52. These are record yields. And on the next slide, you can see what does record yields coming out of record high prices do? Well, if you have a period of very high prices and then you get record yields, if you get record yields, you generally get record crops. The markets are moving to solve that issue, and then that's the forcing mechanism by which markets can help prices to find new levels. So we're just using the corn price here because corn competes with wheat breakers in the US. When wheat was going up a lot through the war, corn moved up in sympathy. And then what allows corn prices to come down? Well, we have a couple of new harvests next year's new harvests with record yields means you get record production, and then prices can float their way back downwards. So this just goes to show the adaptability of trend following, that it's long for a period when prices are going up, then it exits over the course of a couple of months as prices are moving sideways, and then as prices are moving back down again, we can participate on the short side as well. We think that's a real valuable thing. Again, where else can people get exposure to the short side of commodities? The next chart has the same thing with natural gas, where you can see it again. We've got the whole period here. You can see the two spikes in early 2022 when the war was really spiking gas prices. Europe managed to got a little lucky maybe with some mild winters, but European gas storage rebounded quite strongly, and prices began to fall again. And we've been short since the early part of 2023 and remained short at least through the end through this period. So again, you've been able to participate on the long side when prices are going up, and then on the flip side when prices are going down and the world the panic starts to subside. You can participate on the short side, and short sides are real valuable here. Okay, I think Jerry, do you want to run through where are we now? We've got a couple of questions.
Yeah, where are we now? We got a few minutes left, and we got a couple of questions we want to get through as well. Next slide. We talked a little bit about gold not doing well in 2022. While here in 2024, gold certainly has gotten a bid here. Again, a little bit of the flight to quality, a little bit of the U.S. Moving to a rate cut environment. So anything that's sort of weaker dollar has got gold moving up. So gold's made a couple big moves here, big moves higher here. I think as long as there's sort of a weaker dollar policy, sort of in effect, I think gold continues to hold these prices up here. But that's where we are with gold. You go to the next slide, and we're going to talk a little bit about where we are positioned over the last 12 months. Similar chart that we were showing along the way with the lines. This just has the trend signals by market over the last 12 months. If you look sort of over on the right hand side to August and September, you see on the commodity side, we're long gold and long copper. Copper is its own story. Electrification takes a long time to get new supply. Have prices really moved in copper yet? Probably not. We think that's up and coming, but we'll see what day it actually happens. Energy markets, we've been short. Prices have come down, particularly in crude oil, from 80 to 70 into September. We'll talk a little bit about this positioning and current performance over the last week as well. And again, you see that on the foreign currency side, we've gotten long foreign currencies over the last couple months. So weak short the dollar, and bonds have gone from sort of mixed and short to almost fully long there at the end of September. So that's where we are today. Weak dollar with the index at the end of the month, into September. Weak dollar, long bonds, short energy, long gold and copper. And so what's happened here so far, as far as recent performance in October, a lot of that move that sort of transitioned the index into those positions has backed up. We've had the Fed and Powell come out a little bit hawkish, saying maybe we don't need to cut rates all that fast. You had a really strong jobs report, so that's sort of that last move. The last move up in bond prices has unwound. Sort of back to where it was in early August, after around August 5th. And then energy prices have a bit of a bid here with the sort of escalation in the conflict in the Middle East, going from 70-ish to mid 70s. So in percentage terms, a decent move, but we've certainly seen a lot bigger moves in energy prices over the past 4 or 5 years, ranging from negative to 130 and back again. So the current moves in energy are pricing in some of that Middle East risk, but the supply of crude oil really, it's a well supplied market. By the U.S., Saudi Arabia has come out and said they sort of broke OPEC and said we're going to aggressively take back market share regardless of price. So you got Saudi and the U.S. ready to pump to sort of mitigate any Mideast risk on energy prices. So that's where we sit today. The last week's been sort of a backup in prices. You call it a trend reversal from where we were at the end of September. So we'll see where that settles down, going forward from here.
We have a couple of questions come in. One from Justin. Great question about the decision to not use equities in a portfolio. As a portfolio element, the negative beta of going short stocks can really help offset. Yeah, that is true. There's a place for it. Generally speaking, the reason we don't do it is that it's more for the other side. It's on the long side in particular, that generally people's portfolios are overweight or full of equity and credit risk, and we just generally think that you don't need us adding to that if equities are going up. And we saw a little flavor of that move in August, where the equity markets sold off quite aggressively, and managed futures exposures that did have equities got hit more than those that didn't. So does the negative side help if you're going short? It can do. We think generally that if we were to do that, you've got to think the other thing we would then do is to reduce other exposures, and we think that those other exposures, like being able to be short oil that moves a lot more, or long bonds, are more beneficial in a portfolio, and we generally just don't want to be adding to people's exposure on the long side. So it's an okay thing to do. I'm not totally against it, but as a portfolio element, that's how we view the world. We look for maximum skew, and we think that if you're trying to do that and look at it as a portfolio element, you don't need us adding equities into a portfolio as well. The other part is the one that we get a lot. It's a really good question. It's a tough one. How much managed futures do I need in the portfolio? Well, that is a difficult question. It depends what else is in your portfolio. We run a lot of optimizers. These you can find on our blog that have looked at different portfolios and different portfolio weights. And if we zip forward to slide 27, you can see a couple of those exposures. We generally think that something like 10 to 25% is are reasonable numbers, but we understand that's quite a high number for people to get comfortable with. But generally, if you run an optimizer, those are the numbers you get. And you can see here, we've got some examples of, if you have 60-40 stocks and bonds, and then start to blend in managed futures, what it can do to the drawdowns. Generally, you don't sacrifice much return, at least you haven't historically. Volatility drops quite substantially, and the drawdowns of overall portfolios drop. So on the right here, we've got the a version of an efficient frontier. And in portfolio construction, what you're trying to do is move the chart, move the dots up and to the left. So you get higher rates of return for lower levels of volatility, and that's generally what it does. So something like that level of exposure, I think, is about right.
Yeah, I mean, the way I think about that is computers love managed futures, right? Optimizers love managed futures, asset allocation models love managed futures, because they're dispassionate in their approach to asset allocation. As we talked a little bit before about managed futures being a positively skewed asset class, and what asset allocation models love is the fact that managed futures tends to get really negatively correlated to stocks when they're going down, and you get those big right tail events in managed futures at the same time you're getting those negative tail events in equities, and optimizers love that. Lowers overall portfolio risk. It improves Sharpe ratio. It does all the things. Computers don't have to worry about sort of the day-to-day frustration where your equity investments are just doing great, and your managed futures investments are just kind of plugging along and doing less good than stocks. So when you look at sort of the fullness of time, the fullness of cycles, managed futures historically has given you that diversification and been really important to improving the overall investor portfolio. So that that's and for us, David and I, true believers, we tend to agree with the computers on that analysis. So
you can see some of that on slide 28. Actually, if you just move forward one slide, you can see the risk offset properties. This can sort of give you a bit of a flavor. This is using the index returns. Again, in previous crises, how well did managed futures do? If you're looking at how much of it do you need to offset equity risk, this slide gives you some sort of guidance as to that. It needs to be a meaningful amount.
And I think it's important also to know that we run this. We expect the volatility of KMLM to be around 15%. So it's not a volatility we target; it's a volatility we expect over a market cycle. So sometimes it'll range higher, and sometimes it'll range lower. But in general, it kicks off a volatility similar to the volatility of stocks. So that also helps making the asset allocation decisions easier, because it's a lot harder sometimes with bonds, that have a 5 or 6% volatility, to say how much bonds do I need to offset stocks, because you really have to ramp up the bonds. But because we're delivering KMLM at a similar volatility of stocks, it makes the asset allocation decisions a little bit clearer. Another question in here about any other commodities, currencies going to be added to the MLM index in the future. The way the index works is we have an index committee that meets annually to determine market constituents in the index. In general, we do not change the constituents often. There are more markets that could be added, but you're always trying to balance. If you're just adding 1 or 2 more markets, their incremental benefit is not great. We like owning sort of the more liquid, the more developed, the biggest markets, because those are the markets that react most directly in a period of stress. So you want to have the bulk of your asset allocation in managed futures, 2 bonds, 2 currencies, or to the euro, to the yen, to the US 10-year, to the UK long gilt, to crude oil and soybeans, and not necessarily in smaller, sort of less important markets.
And I think there's one final question on there about, can you alter the holdings the next day to respond to new events? And yes, although it's a long-term trend follower, we do evaluate the signals every day, and it might take a few days for us to get from fully out or to fully switch positions. But we do evaluate positions every single day and are trading in something generally every day.
Yeah.
Well,
what we don't do that we don't intervene on a discretionary basis. If we think the price is too high, maybe we should get out. From a PM standpoint, we do not intervene in the markets unless we feel that there was the market was broken in some way. The example I would or there's an operational thing that needs to happen. At one point in the history, unleaded gas moved to a different contract for RBOB unleaded gas, and the entire market shifted from one contract to the other in basically over a 3-day period. So we would, roll that contract out and move to the one that everybody's using. So that's sort of an operational thing. A market broken type thing would have been the May contract of crude oil in the May 2020 when it went negative. That was a unique event. We were trading in the June, or the index was in the June contract, so that one did not go negative. But during that period, we did move out to a couple months to September, to the September contract during that period, because that was a really short-term situation in a particular contract that was completely mitigated by just moving the contract out a couple months. So it's really only in rare, unique events. On a day-to-day basis, we are not looking to override the signals in the fund. I think that's there was one other question there from Stan. Is there a black swan or other event that inverts a trend overnight? Can you? Oh, we just talked about that. All right, so we got to that one, Stan. I think that's it. Well, I'd like to thank everybody for joining. Sorry we went over a couple minutes. Appreciate you guys tuning in, and enjoy the markets and enjoy. For me, I'm going to try and enjoy some playoff baseball. We got some great series coming up: Mets, Phillies, Dodgers, Padres. We got Detroit, Cleveland out there. So a lot of good baseball coming up. So enjoy.